Hello everyone, warm welcome to Testbook Super Coaching Regulatory Bodies YouTube channel. My name is Madhav Sir. I welcome you all in the next and a very important session in the series, that is Basics of Finance. If you remember, in the previous session we have discussed a very important topic, that is NPA, which stands for non-performing asset, and we have discussed SAR-FACI Act as well in our evening masterclass. So today we will move forward and we will be discussing a very important topic in the same order, that is CAR or CRAR. The term CAR stands for capital adequacy ratio, or it is also termed as capital to risk weighted asset ratio. Now the question is, so what actually the capital adequacy ratio is, or capital to risk weighted asset ratio is? If I write down the same term in a mathematical form, then I would say capital to risk weighted asset. Capital to risk weighted asset, and this ratio is known as CRAR, or it is termed as CAR, that is capital adequacy ratio. But the question over here is, sir, what do you actually mean by this capital over here and risk weighted asset over here? So basically the capital word over here is capital reserves, or I would say the reserves which you are maintaining out of the capital. And why you are maintaining these reserves? So you are maintaining these reserves in order to counter the impact of NPA or credit loss in the near future. Second term is risk weighted asset. Sir, how you define the term risk weighted asset? Let me explain you. Whenever we use this word risk weighted asset, we need to understand this point very carefully. RWA, that is risk weighted asset. Now, let's take an example to understand this particular point. It's going to be very important and you are going to enjoy it for sure. See, let's suppose I'm talking about a bank, let's say State Bank of India, and this bank has accepted deposits from the public. Now, what will bank do? Sir, after accepting the deposits, as per RBI, bank is liable to maintain certain amount in the form of liquidity reserve ratio, which further include cash reserve ratio as well as statutory liquidity ratio. But on the other side, bank can use the funds in terms of investment and all. And after doing all those things, bank will be left with adjusted net bank credit. Bank will be left with adjusted net bank credit, or I could say that lending which is actually done by the bank. Now, let's suppose bank is lending the amount. Let's suppose bank is lending the amount and bank is going to lend the loan in different areas. So what I'm doing over here is, sir, let's suppose I'm calculating or I'm making a chart on for a date that is 1st April 2025. That means I'm trying to estimate how bank is going to do or how bank is going to work in the next financial year starting from 1st April 2025. And let's suppose in the entire financial year, just for your ease, in the entire financial year, that means in the entire upcoming financial year, bank is expecting to provide a loan of value, let's say 100 rupees. Let's say 100 rupees. Now this 100 rupees will be given in priority sector lending, that is 40% bare minimum, and rest will be given in the commercial sector lending, that is left out 60%. I've just taken the minimum values. Now in priority sector, bank will be providing loan to the agriculture sector. Bank will be providing loan under the priority sector lending not only to agriculture sector, but we have many other sectors as well in the priority sector lending part, which can be related to your social infrastructure development or health infrastructure development, green energy infrastructure development, or to our I would say the startups and all. So we include all of them. Let's say I include all the categories as X. Then we have certain lendings to the industry. Then we have certain private lendings, or we call it as personal loans. Let's say 30 rupees is lended to agriculture, 10 to extra industry, let's say 40 and 20 in the private loan category. Now, what I'm trying to discuss over here, I'm trying to discuss that every bank is liable to calculate or to estimate their loan values, which I have estimated for you. And out of these loan values, bank will be coming up with the term that is risk. Now the risk for different loan is going to be different, and this risk percentage for different categories is defined under Basel norm, is defined under Basel norms. And in the Basel norms, it is defined that in agriculture sector, let's say the risk is 50%. In others, let's say it is 100%. In industry loan, let's say 50%. In others, let's say it is 100%. So from here, bank will calculate its risk. That risk will be 15 rupees over here, 10 rupees over here, 20 rupees over here, and 20 rupees over here. If I add all of them, 20 plus 20, 40, 40 plus 25 is 65. So what is the estimated risk? So the estimated risk is 65, and this risk is known as risk-weighted asset. Now I explain you after this particular example. What I'm trying to say. So whenever we talk about RBI has asked the banks to calculate their risk-weighted asset. What is risk-weighted asset? So risk-weighted asset basically means the sum of risk on each and every loan which bank is expecting to give in the near future. And how this risk is calculated? So it is going to be calculated as per the norms given by Basel norms. The moment bank calculate risk-weighted asset, then bank is very well aware that in near future, if the 100% lending done by the bank has been considered or has been included under the category of NPA, has been included under the category of NPA, then in that particular case, the actual loan or the final loss the bank which is going to bear is going to be RWA. This is the actual loss which bank is going to bear if 100% loan is termed as NPA. Why I'm saying this? The reason is, let's say bank has given 100%, 100 rupees of loan, and if 100 rupees of loan is turned into NPA, that doesn't mean bank will lose 100, because bank will be capable to recover some out of it. Bank will be capable to recover some out of it by selling the assets which have been taken in the form of mortgage, and rest of the amount which bank cannot recover, which is going to be bank's loss, is basically termed as risk-weighted asset. Now, what is capital adequacy ratio? Capital adequacy ratio means every bank in the economy is liable to maintain certain amount as reserves from its capital or out of its capital, and that amount which bank is going to maintain as a reserve from its capital, that should be in ratio to RWA. That should be in ratio to RWA. So what is capital adequacy ratio? So capital adequacy ratio is basically the bank's capital reserves with respect to the bank's risk-weighted asset, and that is known as capital adequacy ratio or capital to risk-weighted asset ratio. Now, as per Basel norms, it was stated that every bank should be maintaining this ratio as 8%, which means if banks estimated risk-weighted asset, if bank's estimated risk-weighted asset is, let's say, 50 rupees, then bank will maintain capital reserves at least 8% of RWA. So what is the capital reserve? So capital reserve is going to be at least 8% of RWA. And this is the norm which is given on the international standards that every bank in the country, or every bank which are the members, or every bank in the country of those central banks which are the members of Basel or BIS, they are liable to maintain these reserves, and these reserves are termed as capital adequacy ratio. Let's read more on this. Remember that if someone asks you how capital adequacy ratio is calculated, so capital adequacy ratio is calculated ratio against risk-weighted asset. Ratio against risk-weighted asset, and this risk-weighted asset is basically the aggregated risk-weighted asset for credit risk, operational risk, as well as market risk. So not only the credit risk, the way I have taken my example, not only the credit risk, but also the other risk of the banks, which include the operational risk of the bank, which include the market risk of the bank. All these risks should be calculated by the bank beforehand. Once bank has calculated these risks beforehand, then against these risks, bank is liable to maintain a reserve, and that reserve should be at least 8% of the weighted risk, which we call it as risk weighted asset. which we call it as risk-weighted asset. So according to Basel norm, it was 8%, but RBI came up with the statement, no sir, you don't know India. India is a nation where we witness, high risk, where we witness greater possibility of NPAs, where the risk value is high. So if you are saying that you should maintain at least 8%, so we will not be maintaining 8, rather we will be maintaining 9%. And BIS come up with the statement, so okay, we are saying at least 8. If you are going more than 8, that is fair enough. We have no issue with that. So that is basically termed as capital adequacy ratio. Now let's summarize this. Capital adequacy ratio basically means out of the bank's capital, bank is liable to maintain certain reserves, and these reserves will help the bank to counter these reserves will help the bank to counter bank's credit risk, in the near future. Now, in order to counter the bank's credit risk as well as the operational risk and market risk, every bank will calculate its risk beforehand. That means bank will sit tight, and for the next quarter, for the next financial year, bank will first calculate the risk value. Once bank is aware of the risk value, then as per that given risk value, bank will be maintaining the reserves, and that too out of its capital. Now, what is capital? So capital are the funds which are basically used by an organization, by a company, to earn profit. And in banks, this capital is divided into two categories. One, we have tier 1 capital, other we have tier 2 capital. We have one more category that is known as additional tier 1 capital. What is the difference? So tier 1 capital include the capital which bank has raised through its shares. That means bank has issued its equities to the public, to the market, and bank has raised the funds. Even in the case of tier 1 capital, we include the preference shares, and in the case of tier 2 capital, we include the debts, the funds which bank has raised in the form of debt. So from tier 1 and tier 2 capital, bank is liable to maintain the reserves. And if I talk about these reserves, so from tier 1 capital, bank will be maintaining 7%. From tier 2 capital, bank will be maintaining 2%, and total is going to be 9% in India. Total will be 9% in India. But if you talk about the global standard as per Basel norm, that is going to be 8%. Is it clear? Now let's check out the calculations. The CAR is calculated tier 1 capital plus tier 2 capital divided by risk weighted asset, and this ratio should be at least 8%, the reserves which you are going to maintain. Tier 1, it is responsible to absorb the losses without a bank being required to stop trading. So it consists of ordinary share capital, equity capital, audited revenue reserves, as well as intangible reserves. They are included in tier 1. In tier 2 capital, we included those, or tier 2 capital is responsible to absorb the losses when bank is going to be bank is in a situation to be winding up. That means bank is going to be closed down, and at the time of close down, all those losses which are going to be entertained, they are going to be entertained through tier 2 capital, which basically majorly includes the debt, or I would say the debt issues done by the bank, and those are included in tier 2 capital. But in tier 1, we have additional tier 1 as well. So tier 1 plus additional tier 1, their total is going to be 7%. And if I talk about tier 2 capital, so it is going to be 2. And in total, your capital adequacy ratio is going to be 9%. This is how we define it. But I repeat it again, Basel said it should be minimum 8. RBI said, okay sir, we are aligned. We will be maintaining 8. But we will be maintaining more than 8. You said at least 8. We are saying more than 8, and we will be maintaining 9%. Now the question is, what is risk-weighted asset? In very simple terms, risk-weighted asset is the sum of risk of the bank on all the assets, which include the financial assets. This risk not only include the credit risk, it also include, along with credit risk, it includes bank's operational risk, bank's market risk. So as we know, that risk is basically the probability of loss which a bank may witness or a company may witness in a near future. So that probability of loss include all the different heads of probabilities, and on the basis of that, risk-weighted asset is calculated, and on the basis of risk-weighted asset, capital reserves are going to be calculated, which are maintained by every bank in the form of reserves. Is it clear? So let's conclude this part once again. Let me take an example once again. So let's say we have a bank SXI. This is a new bank which is going to start its operation, and this bank is going to start its operation from 1st April 2025. So it has no past record, nothing. It will be working on the estimate part. So this bank from day one estimate its risk weighted asset, which include credit risk, market risk, operational risk, everything. And this bank from day one will maintain the reserves out of capital in order to counter the losses in the near future. So this bank, what this bank will do, first this bank will calculate RWA. Once the calculation of RWA is done, then from its capital, bank will maintain a reserve so that the capital which is reserved from tier 1 and tier 2 capital, that should be at least 9% in India, and globally it should be at least 8%. And the bank which is already running, in that case, they will be considering their earlier reserves. On the basis of earlier reserves, they will be calculating their expected losses or expected risk in the near future, and then they will be completing this calculation. If you want to learn more, what are the heads of tier 1 capital, all the heads. If you want to learn more, what are the heads of tier 2 capital. If you want to learn more about the part where I said that Basel has defined the risk on different assets, then you need to join our upcoming batch, that is RBI Grade B 2025 Lakshya batch, where I will be discussing capital adequacy ratio in 1.5 hours and Basel norms in 3 to 4 hours, where I will be discussing all these nitty-gritties. Do subscribe to this batch right now. Use the code MADHAV in order to enjoy maximum discount, so that you can complete or you can achieve your dream to be an RBI Grade B officer in the upcoming year to go. Thank you so much. You can download the PDF from the given Telegram link, and I will be catching you all in the next session. Till then, guys, stay home, stay safe, and take care. Bye-bye. Thank you so much. Bye, guys.